everyone. This is Richard Solomon on Taking Care of Business, tcbradio.com. Today we're going to be talking with Michael J. Golub, an attorney who specializes in the field of tax. Yes, tax. We've had some other shows on tax, but this one's going to be a little different because we're going to be talking about saving tax money through 401k plans. Michael, welcome to the show, and tell us a little bit about your experience with representing businesses and people with regard to federal tax and local matters.
Sure. Well, good morning to your listeners. Good morning, Rich. Our legal practice has focused on small business owners for the past 25 years. And in addition to doing various corporate work, everything ranging from corporate formation, entity selection, to implementing documents that govern the relationship between shareholders or LLC members or partners, to transactional work and planning work. And one of the key elements of that over the years has been planning involving the establishment of qualified plans. And when I say qualified plans, that refers to tax-qualified plans that are governed by the Internal Revenue Code and offer certain tax advantages to business owners.
Why do we want them? And when someone says, "I'm just a small potato," will it really make a difference? What do you have to say?
Well, the average small business owner has, I think, a desire to minimize their tax burden, and combined with that, a desire as a business owner to plan for their own personal future. And qualified plans like 401k plans offer really the optimal way to do that by generating a tax deduction and concurrently allowing the business owner to set aside funds that grow tax deferred for their use when they reach retirement age or another event occurs that allows them to take a distribution.
So let's just jump into a quick example for all the listeners out there. I'm a small business owner, ABC company, and let's say I make $75,000 a year. Mm-hmm. Let's say I come out with, at the end of the year, maybe $25,000 in net profits after expenses. What happens to the 401k and income, and what gets deducted, and how does that all work?
Okay. Well, let's take your example and let's make another assumption, which is that you're the sole owner of the business, and I'm going to focus on a 401k solution as opposed to some other options that are out there that are similar to 401k, simple IRAs or SEP IRAs. But let's look at the most flexible, easy to plan with vehicle, which is a 401k. You have net profit, you said, of $25,000. You've taken salary of, let's say, $35,000. Let's assume that that you've deferred some money into a 401k plan, but you as the employer want to put away some of that profit, and you take 10%, a 10% profit sharing contribution to 401k plan for your benefit. So that's $5,000 of additional employer money that goes into the 401k plan. And again, in this example, you're the sole owner of the business, therefore that money ultimately is for your benefit.
So just to clarify, so are you basically matching your own contribution away? Because
well,
in a way?
We can get to that. But for the time being, I think all we need to know is there are two ways to get money into a 401k plan. One is for the employee, whether it's an owner or not. One is for the employee to defer his own wages into the plan. And the second is for the employer to make a profit-sharing contribution. The 401k is a combination deferral and profit-sharing type plan.
Okay.
So I'm going to ignore in this example what the employee is doing and focus on what the employer could do. It could be in the form of matching. It could be just a profit-sharing contribution. But in this simple example, employer has $25,000 of additional funds available, and let's assume that there's, I think you had mentioned $25,000 of salary. Maybe you said $35,000, but let's say it's $25,000 of salary, $25,000 of profit, and the employer says, I'm going to make a 10% contribution on top of what employee has put into the plan, $5,000. So $5,000 goes in, additional $5,000 goes into the plan. That's in an account, an investment account, just like any other investment account, and the earnings on that account grow tax deferred.
Now, let me ask you a quick question. Where is this money? Is this money that you control? Is this money in a bank or like in a brokerage type firm, or how does that work? And can you invest into things like real estate or gold? How does all of this work?
I'll answer part of that question now, which is, and it's a good question. If you're invested if you were to save money in an IRA, assuming you could do that, first of all, there's a lot less flexibility, but let's assume you put this into an IRA, you would be dealing with an institution like a Fidelity Funds or Vanguard or T. Rowe Price, who sponsor and act as trustee of the IRA. If you sponsor your own individual 401k plan, and we have a very cost-effective option that enables clients to do that, if you have your own plan, then you act as trustee and you control the funds. So instead of having an investment fund at Fidelity or at any other financial institution under the name Person X, you have it in the name of Person X Employee Benefit Plan, for example. And you manage the funds as trustee of those assets. So let me go back to the example where employer has put away $5,000. Employer writes a check to Company X Employee Benefit Trust and deposits the money into the financial institution and manages that money. If that $5,000 were bonused out to the employee owner, and if the employee owner had a tax rate of, let's assume, 40%, then $2,000 out of the $5,000 would go to the government. And only $3,000 would be left in a taxable account. Now they make another assumption that the owner, the business owner, is 40 years old. That $2,000 that extra $2,000 that you've saved by getting a deduction, by putting the money into the plan, is available for 25 years until retirement, from age 40 to age 65. And the earnings on that $2,000 in year 1, 2, 3, and all the way through year 25, and then the earnings on those earnings all those years stays in the investment account, the pension account, working for you.
So it keeps accumulating and accruing.
It keeps accumulating and accruing and growing, and it's essentially as if you are borrowing the money that would have otherwise been paid to the government to build your retirement future. When you take the money out, it's taxable. However, the growth and deferral of taxation on earnings has more than made up for any tax you might have to pay down the road. So it's a fantastic and powerful savings vehicle.
So back to the other part of the question, which is, I'm in control of my own 401k. What are the limitations of where I can and how I can invest it?
Okay, so there is a complex set of rules that govern the investment of pension assets. And the reason they're complex is because the government, Internal Revenue Service and Department of Labor, have a kind of one-size-fits-all approach to pension assets and how they're invested. So a large corporation with thousands of employees could be treated in the same way as a company with 2 or 3 employees. The bottom line, however, is that if you invest the assets in traditional investments, mutual funds, stocks, bonds, treasuries, there is very little risk and very little to learn in terms of how to manage the assets. So, generally speaking, a business owner will simply establish an account that is a traditional investment account. Now, if the employer wanted to purchase real estate, for example, it could be done potentially, but you can't have what are called party in interest transactions. So pension plan can't acquire a building, for example, and lease that building back to employer under normal circumstances for some business purpose. That would be a prohibited transaction, so to speak.
So they're not looking for self-dealing.
Exactly.
And I guess the Rich Solomon 401k plan that invests in bingo earnings in Miami Beach would probably be prohibited as well.
Well, if your plan, let's assume you're the sole employee, and you have $50,000 of assets in your plan, and you take $50,000 and invest it in a single venture somewhere, private venture, there's nothing that prohibits you from doing that as long as there's no self-dealing or party in interest transaction. But there is another rule which says that putting all your eggs in one basket is not a good idea. So that applies really in situations where there are employees. If you have 10 employees and you're managing the assets for those employees as opposed to them having control over their individual accounts, you have a duty to act prudently with respect to their assets, and that means investing them in a range of investments rather than putting all your eggs in one basket. So it's a little more complicated when you have multiple employees, but not insurmountable.
Right, and we've seen that where people were like 100% invested in stocks like Enron, and were basically wiped out when Enron, went out of business.
That's correct, and they're right. There are companies that and programs like employee stock ownership plans that allow an investment in employer stock, and that can be problematic if the company suffers from financial decline.
When we come back, this is the fastest hour of tax we've had so far. When we come back, I want to ask, can you have both a 401k plan and a SEP IRA and some other rules? This is Richard Solomon. My guest is Michael J. Golub, attorney, tax expert, 202-785-8887. We will be back right after this quick break. Again, it's 202-785-8887. You're listening to Taking Care of Business, TCBRadio.com. And we're back. This is Richard Solomon, Taking Care of Business. TCBRadioWCWP at yahoo.com is our email. Our website is tcbradio.com. And our YouTube site, when you go onto YouTube, we are TCB Radio, WCWP. Look us up. We have a lot of great stuff on the website, and it's ever growing. And very soon, if it's not up there yet, we had a very great interview about the Beatles with BBC historian Kevin Howlett, who is an archivist and historian for the BBC on the topic of the Beatles. That was, for those out there who love rock and roll, that's an interview that should be up there very, very soon, if not already. We are talking to Michael J. Golub, who's an attorney and a tax expert, and a person that I collaborate with on heavy-duty transaction matters that are well beyond my capabilities. And I look to him. He's done things for clients involving, reorganizations. They call them de-reorganizations and exchanges and things involving property swaps, and he does great stuff. We happen to know each other for a real long time, and we've worked together for a real long time. And he's just a personal friend and a great lawyer as well. So before the break, we had a quick question, and the question was: can you have both a 401k and a SEP IRA, or there's limits on that too?
Well, right. The SEP IRAs and the simple IRA, 401k, they're different animals.
But can you have a zoo? Can you have all the? Or are you only allowed to have one kind of animal at a time?
Generally speaking, you would have only one, and you don't really have only a need for one. There are overall limitations, maximum annual contributions for an employee. So that limitation in 2014 is $52,000. And the question is how you get there. In a 401k, you get there by deferring a portion of your salary, and the limitation on what you can defer is it's the lesser of $17,500 or 100% of compensation. If you're older than 50, you can supplement that with an additional $5,500.
Well, is that because you have less time to accumulate the wealth?
Presume that's yes. Yeah. That was those catch-up contributions are relatively recent, but that is intended to allow older taxpayers to make up for the shorter period of time between their current age and retirement age. So, of employee money in a 401k, you could get up to $23,000, and then the balance would come from the employer side. Now, obviously, if you're running your own company and you have no other employees, it doesn't make much difference which pocket it comes out of, whether the employee side or the employer side, because it's one and the same. With a SEP IRA, it's all coming from the employer side. Same $52,000 limitation, and then 25% of annual compensation. With the simple IRA, there's more restriction. $12,000, the lesser of $12,000 or 100% of compensation is what the employee can put in, and then there's a more limited amount, and I don't want to confuse everybody, but on the employer side, it's more limited what can go in.
I don't know if this is a fair question, but why does the government limit your contributions? Wouldn't they want you to really just sock away as much as you can?
Well, that's
or are they just trying to balance?
So you're asking the question: is the government more concerned with your comfort during retirement or with collecting tax revenue? I think
I know the answer.
They'd like to collect the tax revenue so that they can overspend it.
Well, I always kid around in court that that in science we learn that parasites need to keep the host alive and for the parasite to continue living.
Well, listen, it raises an interesting observation. In the old days, before 1986, when a very sizable law was passed called the Tax Reform Act. That was in the Ronald Reagan era. These kinds of plans, 401k plans, were more rare, and there were other kinds of plans called defined benefit plans that employers used, and they were essentially structured as tax shelters. So the amount of benefit that was going to high-paid employees or owners was vastly higher than what was necessary to be paid to lower-level rank-and-file type employees. And gradually over time, the 401k evolved as the preeminent plan, really because the laws were changed year in and year out to not penalize, but make defined benefit plans less appealing and more costly to the employers, and to make 401ks much more attractive. But the end result is that they are not tax shelters, but retirement vehicles. So for the average business owner, yes, they get a deduction, they get a tax benefit, but you have to have the corresponding desire to save for retirement. And if you want to target a retirement deposit each year greater than $52,000, you could, in fact, depending on the circumstances, combine the 401k plan with sponsorship of a defined benefit plan. It raises a whole host of issues. And from the employer standpoint, you have to go through the exercise of evaluating the cost. So if you get a $50,000 additional deposit from sponsorship of a second plan, it may require you to put some money aside for employee if you have an employee.
Okay.
Well, the deduction of that $50,000 has to be weighed against the cost of what's being put away for the employee. And it may, what I'm suggesting is it may nevertheless be beneficial from an economic standpoint for employer to make the deposit, to have the second plan, even if you have to give away some money to an employee. And that's an analysis that has to be done. I would say in 99.9% of all situations, to the extent that you implement a second plan and get a deduction, the tax savings alone pays for the plan, pays for all the administrative costs of setting it up and getting it started, and covers the cost of an employee. And then year in and year out, you can continue to fund it and benefit from it. But that's a process that has to be carefully considered before someone sponsors a second plan.
So in these very rough economic times, can you not make contributions because the profit wasn't there, or there was just a big cash crunch or something like that? And if you don't have the money to invest in your 401k or to put in, can you do something to borrow and put it in?
Okay, well, there are two separate areas. One is, let me address the first part of your question. I will give the favorite lawyer's answer. It depends.
Yep, I've said that more than once in my day.
We don't expect straight answers from lawyers, but let me try to give a straight answer. If you are the sole employee, sole owner of the business, then there's great flexibility. If you have employees, then in a 401k plan, you have to meet certain non-discrimination testing. And that means that you can't have participation only by the owner and not by the rank-and-file employees. Unless you have what is known as a safe harbor plan. And in a safe harbor plan, I'm going to simplify this, but in the safe harbor plan, essentially you have to put away a small percentage of the wages of the rank-and-file employee as a contribution each year. About let's assume for our purposes, 3%. So if you have an employee who's earning $20,000, you put away $600 for them. That $600 is subject to a vesting schedule. So if they leave in 2 years, they may get zero. But it's subject to a vesting schedule. If they stay for 6 years, they get it all. Again, bottom line, in a 401k, you have to analyze the employee population, look at what the targeted contribution goal is for the employer, and weigh that against the cost in terms of employee contributions and, of course, administrative costs. That's an analysis that most of the institutional providers shy away from. And that's why any business owner that really wants to look at these kinds of issues and this kind of planning long-term needs an advisor of some sort, whether it's a lawyer or an accountant, somebody that can guide them through this process. Not that complicated, but it does need to be looked at.
In rough terms, I'm a small business owner. Maybe I have one other person in the business, like wife, brother, sister, cousin, something like that, brother-in-law. So it's closely held. What would it, or a solo practitioner? What would it basically cost, rough numbers, to put something like a 401k plan together for the first, just to get it all up with the right paperwork and this and that, roughly?
Yeah, it depends on the features of the plan, but I would say in the range of $500 to $1,000.
Wow.
Sometimes it can be done very simply. Sometimes we add certain features to the plan and have to go through certain analysis that adds cost to the program. And it's not expensive, and I will tell you that 20 years ago, the minimum cost for one of these plans was in the range of $3,000 to $5,000.
Oh, so it's really gone down.
It's gone down because we no longer reinvent the wheel each time. We have sizable portions of plan document language that's pre-approved by the Internal Revenue Service. So you can customize the plan, but it's a kind of a mass-produced document. So it's become relatively efficient, and our operation, I think we've built in as much efficiency as anybody out there in the marketplace.
So let's say we have, I'm in a 401k plan. I've done nicely. I've put some money away, but now I need to buy a house. And with the whole housing situation, it's tough to get a mortgage. Can I borrow? I remember you can't do self-dealing, but am I allowed to borrow the money out of my 401k plan? Okay,
so this is, again, a good example of how the 401k is more flexible than, say, a SEP IRA or a simple IRA. The SEP and the simple IRA, those are two vehicles that do not allow for loans. But a 401k, which is particularly useful when you're self-trusteed, does allow for loans. And you can borrow up to a maximum of $50,000, limited to 50% of a vested benefit. So if I were to put in a plan for a business that was owned by one individual, and that individual is the sole employee, from day one they would be 100% vested. You'd structure the plan to have complete full vesting on startup. And they have $100,000 saved in the plan. They could borrow 50. If they have 50,000, they could borrow 25. And you have to have a 5-year note. It has to have at least quarterly payments, if not more frequently. And you have to have a reasonable rate of interest. So, yes, it can be done. If there's husband and wife, each can borrow. Each can have an account. So there's some flexibility, but I would say to anyone thinking about putting in this kind of plan, that's not the objective, to create a funding source for borrowing money. It's useful. It gives you flexibility. Use it if needed, but that's not something that you should aim to do.
Well, let me ask the flip side of that. When in the prior part of our discussion on 401ks, for those who are just joining us, we're talking to Michael J. Golub about 401k plans, and especially for small business owners. We were talking before, and we were saying that the government's trying to strike a balance between collecting revenue and letting you retire with some with some money. Is there an upper limit to how much money? Let's say I'm a high income earner. Let's just say, for example, I invented a application for the smartphones, and I'm just raking it in, and I made $5 million last year. Is there a limitation in how much money I could actually put in, even if it's a big percentage or whatever, under the 401k plan? Is there an upper limit?
Yeah, there's something called a compensation maximum, and in that maximum changes from year to year based on a cost of living adjustment that's built into the Internal Revenue Code. For 2014, that number is $255,000. So if you make $1 million, is that if you make $1 million, the most you could take is up to $255,000 of your income, or is the most you can put into it is $255,000? Well, okay, so I'll give you an example to show how that works.
Right.
Let's assume employer. You have a 401k. Forget about what's being deferred into the plan by employees, but employer declares a 10% profit-sharing contribution on top of what everyone has deferred. That's 10% of wage income. So one employee makes $30,000. 10% would be $3,000 goes into that employee's account, subject to vesting. Owner makes $1 million. 10% would be $100,000. Well, you can't put in that $100,000. You can only put in 10% of $255,000. That's the maximum you can consider in the way of compensation for that owner. You can't consider the full $1 million. You can only consider the $255,000, and therefore that person gets only $25,500 into the plan. So,
we have to take a break. So when we come back, what is there special ways for high income earners to shelter, through these tax advantaged vehicles, more of their income?
Happy to talk about that after the break.
All right, this is Richard Solomon. You're listening to Taking Care of Business, tcbradio.com, tcbradio.WCWP at yahoo.com. We're talking to Michael J. Golub, who's an excellent attorney and a close personal friend. 202-785-8887 is his phone number. And we'll be right back right after this. Don't go away. All right, we're back. Richard Solomon, Taking Care of Business with tax expert and close personal friend and friend of the radio show, Michael J. Golub. He's listening since day one, and we're colleagues. We've done a lot of law together. We probably will do a lot of law together. And a great family man, great husband, great father, and great son.
And a former New Yorker.
And a former New Yorker. And all I can say is that he's my go-to tax guy. And I don't say that lightly. Anyway, what I forgot what we were talking about before the break. But I think we were talking about, if you are a high-income earner, are there ways to overcome the limitations set forth in the 401k laws?
Well, there is one overriding umbrella limitation that applies to everyone in a 401k plan.
The mattress only holds so much cash. No.
That's the aggregate limitation on what an employee can have put into the plan for him or her, whether it's from a deferral or whether it's from an employer contribution. And that number for 2014 is $52,000. So even Warren Buffett, if he's participating in a 401k, can only put $52,000 into it. And the question becomes for high-income earners, for companies that are generating significant profit, and there's a desire to shelter that, what do you do?
Right. What is Bill Gates and Warren Buffett and that class of business entrepreneurs? What are they doing?
Well, I'm not going to address that class because for them it doesn't much matter.
Oh, because I always thought that those guys were the people you need to emulate to some extent.
Well, you have to emulate them in their earnings, but if you're making have a net worth of $30-40 billion, a $52,000 deduction is not going to raise your eyebrows. But okay, so take the more realistic example of a guy or woman who's making several $100,000 of profit, or making several $100,000 of salary, and then there is a profit that could be sheltered. What do you do? If you're young, and when I say young, I'm talking, let's say, 48 and below, it's hard to use a second savings vehicle, a second qualified plan like a defined benefit plan. Once you hit 48 to 50, a defined benefit plan can be useful. Okay, so why is that? The defined benefit plan is a different animal than a 401k plan. A 401k plan, a profit-sharing plan, each person has an account. Each participant in the plan has an account, and that's your money, and that's what you manage, and that's what you get at retirement age, subject to vesting. In a defined benefit plan, the contributions are pooled into one general account, and various assumptions are made about growth of that account, age of retirement, your age, and what you need to fund a benefit at retirement age. If you're the sole owner of the company, it's easy to manage and track all of that. But for our purposes today, what's important is that the defined benefit plan focuses in on the employee's time until retirement. And if there's only 15 years, because the retirement age of the plan is 65, and your age 50, you have 15 years, as opposed to a 40-year-old who has 25 years. You have only 15 years to fund the benefit, and therefore the contribution amount is higher. If you're age 60 and your retirement age is 65, you only have 5 years to fund the benefit, and therefore the contribution amount is even higher. So there are, and I am oversimplifying, but there are actuarial variables that go into that plan, and that's a complicated analysis that has to be done. But presumably it's more cost effective if there's significant earnings in the business. And that's a methodology for supplementing what goes into a defined contribution plan and having a second plan layered on top. And there are other variations of that called cash balance plans. But that's something that most definitely requires legal assistance. You can't simply go out to a financial institution, sign up for a plan, and blindly go into it. You have to plan it out and look at it.
How long did it take you to kind of learn all this? Because it just seems like it's constant rule changing and evolution of the way this has gone from the 80s till now, and it's probably ever changing. And
well, I think
like whack-a-mole. They change one thing, another thing pops up.
Yeah, it's a hallmark of the federal government today that for every area of the law, especially in the tax world, every year there are laws passed that make alterations and changes to the law. One would think that you could establish a set of rules and live by them for a period of years, if not decades. But that's, with special interests and all the various problems that we have today in divided government, well, there are changes constantly, and I guess that helps primarily lawyers who have to guide their clients through these complex web of rules. So I think that's a story, a subject for a whole other radio show.
Absolutely. I'll share with our listeners, and maybe you remember this, but when we were taking tax back in law school, we had the good fortune of having Professor Weidenbrook, who I thought was just an incredible professor. And as a joke, I went over to the tax court, not too far from the law school, and they actually have a stamp that says denied. Denied, and it says, United States Tax Court, whatever. So it is, I went to my textbook, and I took the denied stamp, and I stamped it like in 3 prominent places on the front cover, on the inside cover. I bring the book back to school, and I said, "Hey, Professor Weidenbrook, I'm going to get an A on the final. I get an A. And you want to know how I know?" I said, I know everything I need to know on this one page. So I flip open the book. I show him denied. He started laughing. So that was one of the few lighter moments in tax. All right, so let's now go back to the question of, once I have all this money and I'm now in my golden years and I want to be sipping mint juleps on the porch, when and how do I take this money out? And how does that work? And can I be still working and making money and still pulling the retirement money out on top of it if I wanted to?
Well, first of all, I'm very distracted by having the reference to drinking mint juleps, which that's
with the brim hat.
No, that's interesting. Okay, so you reach retirement age. You can retire, take money out. If you're self-employed, you can take money out beginning at age 59 and a half, generally, without any kind of penalty. If you take money out before 59 and a half, there's a 10% penalty, plus you pay income tax on it. So in theory, the notion has been that when you access monies from the plan, from a qualified plan, you're in a lower tax bracket because you're no longer generating wage income. Many clients, and I'm sadly old enough to have seen it, from the start of a plan until the client is actually withdrawing funds from the plan. Many clients have gone on to use plans to withdraw funds, and the tax-deferred nature of the plan just continually regenerates earnings and assets, and they don't end up depleting what's in the plan. They're living off it, off the income and the growth. So, that's very, I think, very exciting to see how much momentum these plans can establish. But you can pull money out. There's a lot of flexibility if you have a self-designed or a volume submitter, a prototype 401k plan. There's a lot of flexibility. You're not forced to annuitize. You can take installments. You can take out a lump sum. Lots of flexibility there. And any legal professional can guide you on that. There's also a generational, and we're covering a lot of territory, but there's a generational benefit where if the business owner and the participant in the plan passes away, that pension benefit can go to your lineal descendants, and your lineal descendants can take the pension assets and put them into an IRA and continue to defer the payment of income tax on those assets for their lifetimes. They would have to be subject to certain withdrawal rules. They'd have to take distributions, but those distributions would be small and based on their life expectancy. And because they're much younger than the owner, it's a deferred, drawn-out process. So again, very, very sizable generational tax savings and deferral.
At what age do you have to take the money no matter what?
You have to take it out no later than 70 and a half.
Okay. Here's the million-dollar question. How do you make sure that you don't outlive your money? Isn't that the greatest fear of most people, that they won't really have enough to retire on? How do people bridge that?
That they won't have enough to retire on?
No, that they won't have enough. How do you make sure that there's plenty of money for you, assuming that you retire and you live a good, healthy, long retirement period, that money isn't exhausted and that you're now struggling just with maybe basic Social Security or something else?
Well, there are we see this a lot in the estate planning arena. We do a lot of estate planning. When a person budgets their overall expenses, whether it's the phone bill, the electric bill, rent, or a mortgage, they should, in my view, have a line item for retirement, inflation, unexpected costs, health care. And many people don't. But that's where a 401k or a 401k combined with a defined benefit plan, that's where qualified plan planning comes in handy. You want to fund as much as you can so that when you reach retirement age, you have a pool of assets that you can draw on in addition to Social Security and any personal savings to live how you want to live. So I think the 401k plan and qualified plans, that's a critical component of any small business owner's overall planning. It's a fantastic tool, and has enormous power, builds tremendous momentum, and can empower you with the use of assets that would otherwise be in the hands of the government through ordinary taxation.
Is this one of the is the 401k pretty much one of the few places that you could really save money in a small business? Essentially, is this like the one great tool that's still left?
It's yes. I mean, I think the answer to that is a resounding yes. Any small business owner, by obligation, is aiming to pay as little tax as possible, looking for methodologies. But there are only so many ordinary and necessary business expenses. You can prepay certain expenses in a given fiscal year. You can be as aggressive as you like in characterizing expenses as business expenses. You can go out and purchase equipment. But putting money aside for your own retirement on a tax-deductible basis, that's a fantastic feature of a qualified plan.
And a great reason why to own a small business.
And small business owners, certainly they want to grow their business. Using a 401k plan is an attractive way to grow a business. If you're going to do that, if you're going to sponsor a plan and you have employees, you don't simply look at what you're paying the employee in the way of wage income. You look at what that employee gets in salary and what that employee would get in a qualified plan. So from the employer perspective, yes, as I said earlier, there's a cost, an employee cost to putting away money in a plan. But really, you might pay the employee slightly less salary because you know they're getting money in the profit-sharing plan. Or you're simply giving them that profit, that piece of the profit, to incentivize them, to build loyalty, to build higher productivity. So it depends on the facts and circumstances. Does it make sense for everybody? No. Does it make sense for a lot of business owners, a lot of people? Absolutely. You just have to look at it, consider it, and apply the individual facts and circumstances, and then map a course going forward.
All right. Well, that was great information. Again, that was our guest, Michael J. Golub, who's a tax expert. If you want to give him a call, 202-785-8887, 202-785-8887. If you're driving or you don't have access to a pen, send us an email at tcbradio.wcwp@yahoo.com. We'll forward it to Michael, and he'll get back to you. All right. Thank you, everybody, for listening. Michael, thank you for being a part of our show and part of the radio family. We'll see everybody next week, and be careful out there and deduct as much as you can. See you in a week.
Great to be with you, Rich.
All right. Thanks, everybody.